The subprime crisis is back. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we're seeing signs that the subprime crisis is back as delinquencies are rising at the fastest pace since 2009. And it's not just consumers that are under stress. A major retailer is on the verge of filing bankruptcy, but is the consumer about to stage a major comeback? Well, there's evidence they may be. Let's over to Bloomberg, where we picked today's story up with a headline: Americans fall behind on car payments at a higher rate than 2009. And the reason this story is important is because when we look at the economy and we're trying to assess, are we about to have a soft landing that the Fed is hoping to manufacture, or is it going to spiral into something worse? And delinquencies are a huge problem, because once you start getting into delinquencies, you get into default, and that comes back to the banking industry. And if you see that prices are deflating and coming down, that means banks take a loss, and a big enough one is not something they can handle. What we can see is during the pandemic, a surge in used car prices forced buyers to take out bigger loans for their vehicles. The monthly payments seemed doable in an area of stimulus checks, a tight labor market, and surging stocks. But that's changed for many people as inflation eats into their budgets and the job market cools. Now, more Americans are falling behind on their car payments than during the financial crisis. In December, the percentage of subprime auto borrowers who were at least 60 days late on their bills rose to 5.67%, up from a 7-year low of 2.58% in April of 2021. So this is exactly what we would expect to see, and we've talked about this on the show, that when you see inflation get out of control, and we'll look at a chart here in a few minutes, that what happens is wages don't keep up. And if wages don't keep up, people can't afford all of their stuff because they have to prioritize food, energy, and shelter. And then what you start to see is stress in other areas. What have we already noted on the show? That credit card charge-off rates are rising. Is it any surprise we're seeing this in the auto loan market? Not at all. It will only accelerate if used car prices come down. Then what you'll see is more and more people will say, you know what? I'm not going to bother making a payment on something I'm upside down on. But not worry, people are saying it's not that bad. Well, not yet. According to that, compares to 5.04% in January of 2009, that peaked during the Great Recession. But remember, we're coming off major lows here. The percentage of borrowers at least 60 days late on their car payment is rising, and rising quickly. But while the number of vehicle repossessions is rising, here you go, it's still below pre-pandemic levels. At Manheim, an auto auction company, the number of repossessed cars increased 11% in 2022 compared to the prior year, but that was still down 26% from 2019. And so you're going to keep hearing news like this that says, hey, yeah, these numbers are moving up real quick, but remember, they're moving off really low numbers, and we're not even back to where the trend was before, so it can't be that bad. Well, that's why you start looking at the labor market, you start looking at the economy, and what are we seeing in the bigger picture is a global economy is slowing. So yes, it's not going to happen right away, but if the economy doesn't stabilize here at some point, well, what we're going to find out, it's only going to get worse. And is there some evidence of that? Absolutely. Let's take a look at this next chart here. What I've done is I've taken the consumer price index and I've subtracted off average hourly earnings of all employees. This is a percentage change from a year ago, less a percentage change from a year ago. And what I want you to see here is when it's above the black line, when you see the blue above the black line, that means inflation is outpacing wages. And you can see that going into the financial crisis. You may recall that we actually almost had a double dip recession. That would be notable right in here around this 2011-2012 period. And what are we seeing right now? The same thing. But notably, during a good economic time, what happens is that wages are outpacing inflation. That would be evidence of when the blue line is under the black line. So it should come to no surprise to us at all that what's happening here for consumers is a big problem. We should expect to see more people miss their credit card payments in default. We should see more people miss their car payments and then default. The only question is, is at what point does it spiral out of control? Remember, these things start slowly and then build and build and build until something breaks. And something else we've noted on this show is many people keep asking, how is it the stock market can keep going up here? Well, we've shown you, here is a preview of the Monday report. We've shown you with our mimic report of the computer modeling, and you've watched it on this report, how the machines have been leveraging up and buying stocks here, because what you start to realize is the U.S. stock market is all momentum based. It's not much to do with earnings and fundamentals anymore. I'm going to be raising the price probably on Monday or Tuesday to $30 a month. It's $20 in the description below. You've seen it here on the show. And what we'll find out Sunday when we talk about the machine positioning in more detail, there's probably a whole lot more buying. And this report tells you how to get in and when to do it. Bed Bath & Beyond now says it received default notice from JP Morgan. Let's go back a couple of days as creditors, no surprise, want cash after the retailer breached its credit line terms. And creditors are demanding immediate repayment of the company's debt after it breached the terms of a credit line, according to a regulatory filing on Thursday. Bed Bath & Beyond listed around $2.1 billion of obligations it's owed as of November. So what I want you to see here, this isn't a broad story just about the consumer and that businesses are A-okay. There's a ton of businesses out there that have leveraged up during easy money times thanks to the Federal Reserve and low interest rates. They borrowed to buy stock back. They borrowed to expand their business. They made poor financial decisions. And what you're going to see is those dominoes are going to start to fall. Now, Bed Bath & Beyond may be the first of many, but if the consumer's in dire shape, if they can't make payments on their credit cards and their auto loans, do you think they're going to go out to stores like Bed Bath & Beyond and splurge? And the answer is no. But it's not just that's the problem with Bed Bath & Beyond. They can't even get inventory in to sell, putting them in a dire position here. Generally, in situations like this where company defaults on their loan agreement are experienced as if they don't come up with an agreement with their lenders, the likelihood of a bankruptcy filing within the next 30 days is relatively high. And no surprise, days later, Bed Bath & Beyond falters in efforts to find a buyer in bankruptcy. The retailer is preparing to file for bankruptcy protection imminently, likely without a bidder in place for assets, including its Bye Bye Baby brand, which is viewed by some as the most valuable chain. They added that talks are ongoing and a buyer could still emerge. So you start to think about all the banks that have probably lent money to Bed Bath & Beyond, and what you're going to likely then see is if they can't actually save the company or sell it, there'll be a liquidation and the banks will take a loss. And so a lot of people look at this and say, well, the banks are solid here. But what I want you to see is look at the credit card space, look at the auto loan space, and if Bed Bath & Beyond is just the beginning, well, there could be a huge wave of defaults that just occurred due to a slowing economy and high interest rates. The Union, a New Jersey-based retailer, spiraled into distress following years of disappointing sales, strategic missteps, and a turnaround effort that came too late. Its troubles quickened when the failure to pay suppliers crippled inventory as vendor shipments slowed. On Thursday, the company said it received a default notice tied to some credit lines, again providing evidence that the problems with Bed Bath & Beyond are broad and they're deep. The only question is how many other retailers are perhaps weeks or months away from being in the exact same position. But is there a sign that the consumer could be staging a big comeback and put some ease to everybody's minds? Well, it's possible. Here we can see consumer sentiment confirmed that the preliminary January reading, this from the University of Michigan, remaining low from a historical perspective, but continuing to lift for the second straight month. So again, we're starting to see a potential trend here, rising 9% above December and reaching about 3% below a year ago. While the short-run economic outlook was relatively unchanged from last month, all of the components of the index increased in January. So all of a sudden, we're seeing some signs here, that the consumer may be bottoming out and ready to turn around. The current conditions index soared 15% above December, with improving assessments of both personal finances and buying conditions for durables, supported by strong incomes and easing price pressures. And that would be great news for the Fed to say that, hey, we ended up engineering this soft landing, and now all of a sudden we can pull back on our rate hikes, and look, everything will likely be okay. But of course, we know that's not how the story will end. And here you can see in this chart, again, this is the preliminary University of Michigan Consumer Sentiment, Economic Conditions, and Expectations Index. And what do we see them all rising off of a low? You can go back and see at points when it does rise off of the low, that isn't a good indication. It's also a great proxy for something else, and that is the stock market. When the stock market goes up, well, consumer confidence rises. And when consumer confidence rises, these people spend more, and that is what the economy needs more than anything right now. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.